Hong Kong is the first in Asia.
Strengthen Hong Kong's position as ETFs marketplace.
Launch of crypto ETFs.
Hong Kong is kind of like a sandbox.
The spot Bitcoin ETFs in the US fueled massive rallies in BTC and the broader crypto market this year. That's why when Hong Kong approved its own spot Bitcoin and Ether ETFs in April, expectations were sky high. But since their launch, Hong Kong ETFs have underperformed, with low volume and net outflows in their first few weeks of trading. This begs the question of whether they'll pick up steam or become just another flop like so many crypto exchange traded products before them. Today, we find out. Hong Kong's crypto ETF launches were supposed to mark a high point in its race against Dubai, Singapore, and other crypto-friendly jurisdictions to become the world's digital asset hub. But it hasn't always been smooth sailing for the crypto industry in Hong Kong, which has flip-flopped between cracking down on and opening up to crypto trading. If you're not familiar with Hong Kong's recent history with crypto, well, you are in luck because we made a video breaking it down a while back. We'll leave a link to it here so you can get the whole picture. But okay, I know, pausing and watching a whole other video while coming back is also a big ask when you're enjoying this one so much. So, let's recap. Hong Kong, population 7.2 million. It's a city-state sitting on the southern seashore of China with a unique constitutional arrangement known as one country, two systems. As the name suggests, Hong Kong is a part of China, but it enjoys semi-autonomy with its own distinct culture, laws, and government structure. This is why, for example, you can occasionally see headlines coming out of Hong Kong about protest movements of a kind that wouldn't be tolerated on the mainland. And this also explains why when Beijing began its crypto crackdown during the 2017-2018 bull run, many of the biggest players in China's crypto scene hightailed it to Hong Kong. For a while, in the late 2010s, Hong Kong was welcoming to crypto in general and well on its way to achieving the coveted global hub for digital asset status. That was until late 2020, when Hong Kong's government banned retail crypto trading and began its own crackdown on the industry. Although institutions were allowed to continue trading and investing in crypto, the damage was done, and much of the industry was scared away offshore. The city-state remained more or less anti-crypto until one day in October 2022, when it made a surprise announcement that it was considering legalizing retail crypto trading. Hong Kong may have a small population, but there is a huge amount of wealth concentrated there, and more importantly, it's technically a part of China, so such a proposition is not to be sneezed at. This announcement was particularly surprising because at the time, a new national security law was thought to have reigned in Hong Kong's autonomy from China. This led to speculation that if Hong Kong was flipping to become pro-crypto, then someone in Beijing must have given it the green light. And if that was the case, maybe China wanted to use Hong Kong as a testing ground for policies that might later be introduced on the mainland. China was quick to pour cold water on this, saying that Hong Kong's stance on crypto was purely of its own volition. But at the same time, it was reported that state-owned banks in China were catering to crypto clients in Hong Kong, and speculation that China might yet soften its stance on crypto continued. Anyway, on the 1st of June 2023, Hong Kong's new alleged crypto-friendly regulations came into effect. They raised a few eyebrows because not everyone in crypto found them to be all that friendly. As soon as they came into effect, any crypto exchange not registered with Hong Kong Securities and Futures Commission was considered an illegal operation. The problem was the SFC only began accepting applications from crypto exchanges on the 1st of June, the day the regulations came into effect. Registration is expensive and time-consuming, as exchanges need insurance, independent assessment reports, regulated crypto custodians, and they need to track every single crypto transaction per the Financial Action Task Force infamous travel rule. Clearly then, Hong Kong wasn't making life easy for exchanges. This was in evidence when the SFC added a raft of products by the Bybit exchange to its list of suspicious investments. It also warned Hong Kongers against using MEXC, which lacks a license in Hong Kong. Then there was BitGet, which decided not to apply for a license and instead withdrew from Hong Kong entirely, just months after setting up a branch there, although the exchange claimed that this was for, and I quote, business and market-related considerations. As of last month, there were 2 licensed exchanges in Hong Kong, Hashkey and OSL. There were also 24 unlicensed exchanges vying for one of the SFC's prize licenses. Between them, these exchanges are competing to serve a market of around 8 million Hong Kongers. At the time of making this video, Hashkey's daily traded volume was around $100 million, while there is no data available about OSL's volume. However, it is worth pointing out that OSL has not had a profitable year since 2019, and not too long ago sold near 30% share of its operation to BGX, an unlicensed crypto group that appears to be based in Singapore. So it was no surprise when Hashkey's CEO Lever Wang told the Financial Times in April that he is not eager to see any more exchanges winning licenses. That would be like a turkey voting for Christmas. For all we know, Hashkey might have cornered the licensed Hong Kong market more or less alone. But that makes it all the more interesting that Hashkey is seeking to expand through its international unit, and I quote, in part owing to fears that Hong Kong's regulators restricted access to overseas investors. In hindsight, the overheated competition between exchanges fighting to win a license and serve a tiny, tightly regulated market generating something around $100 million in traded volume per day can probably tell us something about Hong Kong's ETFs already. And that is that there's an outsized amount of interest concentrated on an officially sanctioned crypto infrastructure that exists for a rather small group of people. By the way, if you're enjoying the video so far, make sure to jab that like button so that more people can see it, subscribe to the channel, and turn on the bell notifications so that you never miss another upload.
Get in here! Take a seat, sir. Go on. So tell me about these anxieties you've been experiencing. When did they first manifest themselves?
Well, I think they first started when I got into crypto. I started to worry about all kinds of stuff.
Such as?
Well, I became anxious that I was spending, way too much on exchange fees. Like every time I made a trade, boom, more precious crypto gone. And I felt like I was missing out in other ways too.
What other ways?
Well, for instance, why didn't I get a sign-up bonus when I registered on an exchange? I mean, come on, they should be welcoming me with open arms.
That's a common feeling for many people in crypto.
Yeah, go figure. And I kept getting told to buy a hardware wallet to keep my crypto safe, but some of those things ain't cheap, huh? I mean, what's a guy to do?
Well, there's a cure for those concerns.
You mean medication?
No, I mean like the Coin Bureau deals page. It has trade-in fee discounts on top crypto exchanges. It offers sign-up bonuses of up to $60,000, and it has discounts on the best hardware wallets too.
You mean I just go to the Coin Bureau deals page and I'm cured?
Yeah, absolutely. Just head down using the link down below.
Okay, I'm on my way.
Now, in April this year, Hong Kong was back in headlines around the world after the Securities and Futures Commission appeared to grant a swift approval of applications for the spot Bitcoin and Ether ETFs from China AMC, Harvest Global, and Basira International. The applications were first reported in English language media on the 8th of April, and by the 15th, they had all been granted approval by the SFC to begin trading as early as the 30th of April. However, it is worth pointing out that it was in December 2023 that the Hong Kong Monetary Authority and the SFC first announced they would accept applications for spot crypto ETFs and release requirements for the issuers to follow. In other words, Hong Kong ETFs weren't built in a week, but rather several months. Now, December to April might not sound like a long time to anyone who remembers the long wait for the US spot Bitcoin ETFs, but it seems there was some grumbling that the process of applications and approvals in Hong Kong was actually taking too long. For example, as early as mid-January, the South China Morning Post cited industry insiders saying Hong Kong, and I quote, needs to speed up approval to strengthen the city's competitiveness in the global cryptocurrency market. And the Hong Kong had, and I quote, fallen behind the US in authorizing spot cryptocurrency ETFs. This is a really interesting take because, on the one hand, it's certainly true that the US ETFs were approved long before Hong Kong's, but the road to approval by the SEC was long and extremely arduous. Meanwhile, this article citing industry insiders telling Hong Kong regulators to hurry up with the approval process was written not long after the SFC and the Monetary Authority first announced that they would accept applications. It makes you wonder just how fast they were expecting, or if they were projecting pure FOMO, because the US ETFs had just launched at this time. Anyway, although Hong Kong may have been later to the party than the US, it did seem that its regulators did try to make the ETF approval process relatively swift and painless. And this cooperative stance from regulators will have been welcomed by the applicants, who had to jump through rather a lot of hoops to get their ETFs approved. To find out what this means, we can turn to a translation of a local report by Hong Kong news outlet Tencent Finance. According to the report, applying for a spot Bitcoin ETF in Hong Kong requires the cooperation of at least 20 separate institutions, including market makers and Bitcoin custodians and institutions holding virtual asset trading accounts. Applicants also need independent ROs, meaning Hong Kong licensed responsible persons who meet the local asset management requirements. It seems that some of them didn't actually have independent ROs, leading to China AMC to hurriedly poach an RO from a small Bitcoin futures institution. As you can see, getting an ETF approval in Hong Kong isn't exactly a walk in the park. That's why it's so remarkable that the applications seem to have been approved so quickly. According to Tencent Finance, some of the ETF applications in Hong Kong have formed a temporary team sometime around early March and submitted their applications in the second week of March. Reportedly, AMC was super fast and received approval in just under 2 weeks, meaning sometime in the second half of March. Notably, this is well in advance of the approvals being officially announced on the 15th of April. And this is significant because, as Tencent Finance points out, and I quote, if Hong Kong's application process and regular communication channels are strictly followed, it is unlikely that any institution in Hong Kong can complete all application materials in about half a month. As China AMC and Harvest Global are subsidiaries of financial institutions on the China mainland, you have to wonder just how this was all accomplished so quickly. We can't say if there were any shortcuts taken behind closed doors, but at the very least, we have to surmise that Hong Kong regulators were extremely cooperative. And for that matter, the spectacle of a monster Bitcoin rally fueled by tens of billions of dollars of inflows into the US ETFs throughout Q1 probably didn't hurt the case for a swift approval of Hong Kong regulators either. At any rate, it sounds like the kind of regulatory environment the ETF issuers in the United States can only dream of. Clear rules, prompt decisions, cooperation instead of combat. The industry-regulated synergy sounds almost too good to be true. Anyway, the SFC's active cooperation and swift processing of the new ETFs came as another indication that Hong Kong regulators don't want to fall behind the likes of Dubai and Singapore and a raft of other jurisdictions vying to become the leading global hub for digital assets. With the ETFs approved and launched in the end of April, Hong Kong became the first jurisdiction in East Asia to have spot crypto ETFs. As the launch approached, optimistic predictions about the impact of Hong Kong's new ETFs on the price of BTC and ETH started appearing. Some of these hinged on the in-kind subscriptions and redemption models of the Hong Kong ETFs, which does distinguish them from their US equivalents, which are in the in-cash only. Under the in-kind model, investors can buy into and take profits out of the ETF products with crypto rather than with cash. Naturally, this is optional, and investors can also use the in-cash subscription and redemption instead. Among the predictions circulating before the launch of the ETFs, our favorite soundbite came from Tong Li Han, CEO of Harvest Global, an issuer of one of the new ETFs and subsidiary of the mainland Chinese asset management company Harvest Fund Management. Han told CNBC that in addition to the TradFi investors at whom ETFs are usually marketed, Hong Kong's ETFs would also generate, and I quote, huge demand from crypto natives who want to stack sats and ETH rather than fiat. Based on this argument, Han reasoned that the market size for Hong Kong ETFs is double that of the United States equivalents. To his credit, he did correctly predict that the Hong Kong ETFs would get off to a slow start, which he put down to investors being sidelined before the in-kind settlement feature starts to show its strength. In a separate CNBC interview, Thomas Su, head of digital assets at China AMC, made a similar argument about the in-kind model. However, he also pointed out that China AMC's ETFs can be traded with not only crypto, USD, and the Hong Kong dollar, but also the yuan. This will have done nothing to dispel rumors that Hong Kong ETFs would be a magnet for investors in mainland China. But we'll get back to that in just a moment. According to CNBC, China AMS was, and I quote, confident that the listing scale of Hong Kong's crypto ETFs can exceed $125 million, although it wasn't entirely clear if this was inflows, traded volume, or assets under management. At any rate, this sounds a little more down to earth than the prediction made by Tong Li Han, who made the prediction about Hong Kong's market size being twice the size of the United States, where the spot Bitcoin ETFs generated $4.6 billion in traded volume on their first day alone. But within hours of the launch on the 30th of April, it became clear this prediction wasn't down to earth enough. In the first 12 hours of trading, Hong Kong's ETFs recorded just $6.3 million in traded volume, and by the end of the day, all of the spot Bitcoin and ETH ETFs combined had generated traded volume of just $11 million. This was a pitiful performance by any measure, and it seemed to catch the market off guard. Between the 30th of April and the 1st of May, BTC plunged 12.6% from around $64,700 to almost $56,600. Now, between all of the expectations and disappointment for the new spot Bitcoin ETFs, it was easy to forget that Hong Kong also launched the world's first spot Ethereum ETF. Unfortunately, this also was a disappointment, as it accounted for just $2 million on the first day's traded volume of 11 million. By the end of the first week, the world's first spot ETH ETF had $54 million in asset under management. Not exactly a blockbuster. Anyway, in hindsight, it's easy to point out that Hong Kong's market for a spot crypto ETF is not, in fact, twice the size of the United States. Market analyst Noel Akeson demonstrated this point by pointing to the historic performance of the crypto futures ETF in the United States and Hong Kong. Akeson noted that 1 year after multiple BTC and ETH future ETFs were listed in Hong Kong, their combined asset under management was below $170 million. Meanwhile, the largest Bitcoin future ETF listed in the United States had more than $2.8 billion in assets under management. On the 6th of May, Bloomberg senior ETF analyst Eric Balchunas chimed in, advising his followers to, I quote, not expect big numbers from Hong Kong based on the performance of the US ETFs, which he said are, and I quote, in a league of their own. What's interesting is that Eric argues that Hong Kong ETFs are, and I quote, already as big as their local market, as the US ones are to theirs. He accompanies this claim with what looks like some back-of-a-napkin type maths, arguing that the $307 million in assets under management reached by Hong Kong's new spot ETFs in their first week would be the equivalent to $50 billion in asset under management in the United States, in relative terms. For reference, Hong Kong's equity sector has a total market cap of $4.5 trillion, compared to the United States of $50 trillion. This hints at a ratio of a little under 1 to 10, which suggests that a $307 million in Hong Kong's market would be closer to $3 billion than $50 billion in the US. Or maybe our napkin math is wrong. Anyway, at any rate, Eric Balchunas' optimistic take was a fresh one. Now, at the time of making this video, it's been almost a month since Hong Kong's new ETFs started trading. If they're going to pick up steam, it doesn't look like it will happen anytime soon. Recently, many of the ETFs are registering 0 daily flows, which suggests either incredibly tight battles between bulls and bears or extremely low traded volume, or perhaps both. When the flows are flowing, it looks like there is rather a lot more sell pressure than buy pressure. At the moment, the cumulative total flows of all of the new spot BTC and ETH ETFs in Hong Kong amount to about $19 million in net outflows. It's not much to write home about. Anyway, aside from the small size of Hong Kong's market and the outsized expectations set by the ETFs in the United States, analysts have pointed the finger at the fragility of the market sentiment of late. This is because, despite the recent rallies in stocks and Bitcoin, weaknesses in China's own economic recovery has investors uneasy. This makes sense, but we can think of another driver of the net outflows seen so far. On the 13th of May, these ETFs saw just under $40 million in net outflows on what was by far the most active day of trading to date. Now, what else happened on the 13th of May? Well, it might be a coincidence, but on that day, the Stock Exchange of Hong Kong confirmed to CoinDesk that Hong Kong's crypto ETFs aren't available to investors in mainland China. CoinDesk's report to this effect appears to have been the final nail in the coffin of that particular rumor. Previously, it had been suggested that the Shanghai Hong Kong Stock Connect, which enables mainland trading of Hong Kong stocks, would funnel billions of dollars of mainland money into the ETFs. Unfortunately, this is simply not true. The ETFs were never available to investors in mainland China. It's fascinating that it took 2 weeks of the ETFs being launched and unavailable to mainland investors for the market to really react to this predicament. It seems that the rumor may have been spread by an extremely lazy reading of a rule which allows mainland investors to access the ETFs if they have Hong Kong residency and are in Hong Kong. So, like Hong Kongers. Well, go figure. That was a very good reason that mainland investors who don't have a Hong Kong residency aren't allowed access to the ETFs. As CoinDesk points out, this would, and I quote, fly in the face of Beijing's monetary policy of controlling the ascent and descent of the yuan, so that exports can remain competitively priced in global markets, and I quote, allowing a trader to purchase shares of a crypto ETF in yuan via a local brokerage account and then sell it for crypto would institutionalize capital flight, adding a significant number of zeros behind the amounts being converted to crypto to leave the country. Well, there you have it. China is probably not going to rip such a big hole in its own monetary policy on purpose anytime soon. So all of this begs the question, what is the significance of the Hong Kong ETFs on the crypto market? As we pointed out earlier, the lukewarm launch of the Hong Kong ETFs coincided with a dump in the crypto market. No doubt many crypto investors and traders caught wind of the underwhelming numbers coming out of Hong Kong's launch day and decided to sell. But the relationship between Hong Kong ETFs and BTC's recent price action likely goes both ways. Bitcoin's price was topped out in Q1 at around $73,780 on the 14th of March. It then began a medium-term downtrend that was punctuated by what looks like something of a double top on the 8th of April at $72,800. The 8th of April was the same day that the English language media first started reporting that Hong Kong's CFC have received a raft of ETF applications. BTC then spent the next 5 weeks continuing a period of choppy downwards, with a bottom of $56,560 on the 1st of May, 24 hours after the ETFs in Hong Kong launched a tepid reception. So on one hand, it is true that the new ETFs launched at a time when BTC was already in a downtrend. This means that the ETFs are certainly not responsible for the medium-term bearish price action, which began in March. At the same time, the bottom of the recent choppy downward on the 1st of May coincided with the lackluster launch of the ETFs the day before. Now let's look at the 13th of May, the dark day when the Hong Kong ETF traders appeared to notice that mainland Chinese investors can access the ETFs, resulting in net outflows of $40 million. This was the worst day for Hong Kong ETFs by a very long way. But when it comes to Bitcoin, $40 million of selling pressure is but a drop in the ocean. You can see it on the BTC chart. It was up 2.37% on the daily on the 13th of May. Not exactly giving grayscale outflow vibes, is it? Anyway, until Hong Kong ETFs receive a huge influx of interest, it seems that the most drastic outflows, and for the matter, inflows, are just not big enough to have a more symbolic impact on the markets. Sentiment rather than actual sell pressure seems to be the more powerful force here. This may remain the case until the day that Chinese mainland investors can access them, although Satoshi knows that if this will ever happen. So perhaps the question on our lips should be less when Hong Kong pump as when China ape. And that, frankly, is a mystery. So you'll have to stay tuned, subscribed, and attentive to your Coin Bureau bell notifications to keep up with the latest from China's will they, won't they relationship with crypto. Right, that is all for today, folks. If you think we are underrating the significance of the Hong Kong ETFs, feel free to roast us in the comments, but be nice. While you're all at it, go on and uppercut that like button so more people can join our conversation. As always, thank you so much for watching, and I'll see you next time. This is Jessica, over and out.